you choose to pay extra tens of thousands in interest over the life of your mortgage? Of course not. But if you don't pay close attention to your credit and take strategic action to ensure good credit score, this could be your reality. Today I will discuss generally how credit scores are calculated and what factors on your credit report make up what percentages of your overall score. I will talk about the ratio of revolving balances on lines of credit and how it can push your score up or pull it down. I will also expand on the options of types of loans you have for various purposes and how choosing the correct loan can improve your score. Let me begin by going over the 5 main factors credit bureaus use in determining your credit score. The first is payment history. This makes up 35% of your score. This is essentially how you make your payments. If you make your payments on time, this will go very well. If you make your payments late, how late are they? Are they 30, 60, 90 days delinquent? The further delinquent you are, the more of a negative impact this will have on your credit. Also, some sub-factors to consider are collection accounts, charge-offs, foreclosures, bankruptcies, liens, and judgments. These are essentially when you owe a debtor money and they have reported negatively on your credit bureau because you haven't paid them on time. The next factor is amounts owed. This makes up a total of 30% of your credit. What are the current balances of your loans in comparison to their original balances? A sub-factor here is credit utilization ratio. According to an article on the website Investopedia by Amy Fontanelli on March 31st of 2017, she states, quote, "Less is better, but owing a little bit is better than owing nothing at all, because lenders want to see that if you borrow money, you are responsible and financially stable enough to pay it back," end quote. This sub-factor is very important, and we'll touch on it a little bit more here shortly. The next factor is length of credit history. This makes up a total of 15% of your overall score. This is how long you have used credit, the age of your oldest account, and the average age of all of your accounts. On the website NerdWallet, article by Tom Armstrong on September 30th, 2016 titled, "What Happens to My Credit When I Get a New Credit Card?" He states, quote, "Credit card issuers prefer customers with extended experience managing at least one line of credit. Therefore, the longer you keep each credit card account, the better your score will be," end quote. So in this is an important factor. If you have multiple credit cards and somebody offers you better rewards or something, make sure you keep your old one if it's your longest credit line, or it could potentially impact you in a negative way. The next one is new credit. This makes up 10%. This is essentially how many new accounts you've applied for and been granted in a recent time period. Underwriters are typically looking the last 12 to 24 months. They will look to see how many different types of credit you've applied for and been granted, thus how much new debt you've acquired in a short period of time. The next factor is types of credit being used. This is the final 10% of your credit report. This is what types of credit have been extended to you: credit cards, installment loans, mortgage loans, store credit accounts. Creditors want to ensure that you have been extended different types of credit and that you've been responsible with each type. Now let's take a look a little bit more at the credit utilization ratio and different FICO models. According to the online website The Balance, in an article by Latoya Irby on August 6, 2016, she states, "A high credit utilization indicates that you're likely spending a lot of your monthly income on debt payments and are at a higher risk of defaulting on your payments," end quote. This is good because there's a 30% rule. She states that the high utilization makes you more likely to default on your loans. That's why they want to see you down below the 30% rule. If you go over 30%, between 30 and 50%, you'll maintain the other factors of your credit. If you go over 50%, you'll drive your credit score down. So staying under 30% will actually improve your credit score based on all the other common factors. The website MyFICO had an article from February of 2012, and it was last updated in January of 2017, titled "Many Flavors of FICO, a summary of FICO additions, versions, and variations," where they state, quote, "Each credit agency, TransUnion, Equifax, and Experian, uses a customized version of each FICO edition. As a result, a consumer's FICO scores from each agency may differ even when all credit information is identical among the agencies," end quote. And what this means is you can go to a credit union, a bank, or some other financial institution, pull your credit, and it will be a 720. Go down the street to another institution, and it could be 700. You'll lose 20 points and you won't know why. It's the different variations in the models that are being used. I'll take just a moment to discuss choosing the correct loan. Let's say your water heater goes out. It's the middle of winter. your first thing that comes to your mind is, let's put it on the credit card. Well, according to an article, Understanding Your Debt at the website debt.org states, quote, the interest rates on credit cards average 15%, but can be as low as 0%, temporary introductory offers, and as high as 30% or more, depending on the consumer's payment history and credit score, end quote. This means that you could be potentially paying significantly more interest for that particular type of loan. There may be better options out there for you, especially if you own collateral that you can use to back up a loan and get a term loan. Which leads me to my next point. Always talk to a trusted financial professional to discuss lending options before making a decision. Take time to research the best option for you. For many, credit scores can be a confusing and frustrating thing to manage. Don't be discouraged. If you have a bad score, you can improve it, oftentimes faster than you think. If you have a good score, take the necessary precautions to maintain your score. Be sure to pay attention to your revolving balances, make your payments on time, and don't hesitate to talk to a financial professional if you feel over your head. With a little attention, anybody can have good credit.